Penn Central Railroad was the largest railroad in America. On June 21, 1970, it filed for bankruptcy. Nobody saw it coming. The story we've always told is simple. Penn Central was a victim of bad timing. The railroad industry was dying, trucks and planes were stealing freight, passenger rail was hemorrhaging money. The interstate highway system had already signed the death warrant. So when Penn Central collapsed, most people nodded and moved on. It made sense. It felt inevitable. But that explanation is incomplete. It's the kind of story that lets people off the hook, because Penn Central didn't collapse because of larger economic forces. It collapsed because of what happened inside the company itself. And what happened inside would become a template for how American corporations could be dismantled from within. Start in 1966. Two railroads merged, the Pennsylvania Railroad and the New York Central. The Pennsylvania was old money, Philadelphia-based, conservative. The New York Central was flashier, more modern. Together, they'd formed the largest railroad network east of Chicago. On paper, it looked brilliant. Synergies, economies of scale, the usual language. The merger created a company worth roughly $5 billion. It employed 94,000 people. It owned 20,000 miles of track. For a moment, it seemed like American industrial might reasserting itself. But the merger wasn't about efficiency. It was about something else entirely. The two railroads had different corporate cultures, different accounting systems, different union contracts. Merging them wasn't like combining two well-oiled machines. It was like forcing two living organisms together and expecting them to function as one. The culture clash was immediate and severe. But there's a deeper problem. The leadership didn't really want to run a railroad. They wanted to play with money. The chairman, Stuart Saunders, and the president, Alfred Perlman, had a vision, not to move freight more efficiently, to create a real estate and financial empire disguised as a railroad. They began spinning off subsidiary companies. They took valuable railroad real estate and moved it into separate entities. They invested heavily in non-railroad ventures, a hotel chain, an airline, a trucking company, a computer leasing firm. Each one was supposed to generate returns that would prop up the dying railroad business. None of it worked. The ventures either failed outright or generated returns so small they were meaningless. But the real problem was hidden inside the accounting. Penn Central was moving assets around, inflating profits, and hiding massive losses. The books didn't match reality. Wall Street didn't catch it. The auditors didn't catch it. The Interstate Commerce Commission, which was supposed to oversee railroads, didn't catch it. Penn Central's stock price kept climbing. By 1968, insiders were quietly selling their shares. They knew something was wrong. In 1969, the company reported a profit of $62 million. It was fiction. The actual number was a loss of roughly $100 million. The difference between what they said and what was true was nearly $200 million. That's not accounting error, that's fraud. By early 1970, the company was burning through cash. They couldn't meet payroll, banks stopped lending. On June 21, 1970, Penn Central filed for bankruptcy, the largest railroad bankruptcy in American history, $2 billion in debt. The stock, which had traded above $80 a share, became worthless. Shareholders lost everything, employees lost pensions, suppliers went unpaid. The railroad that once employed 94,000 people was dismantled, and yet nobody went to prison. The executives who fabricated the books, who sold their shares while lying to investors, they walked away. The SEC investigated. They found that Penn Central's auditors, a major firm, had signed off on fraudulent statements. The auditors claimed they hadn't known. The SEC fined them. Nobody was criminally charged. The culture of accountability didn't exist. Here's what made Penn Central different from earlier corporate collapses. The executives didn't steal money directly. They didn't embezzle. Instead, they used complexity and financial engineering to hide reality. They created subsidiaries. They moved assets. They used accounting tricks that were technically legal but spiritually fraudulent. And it worked for years. The complexity was the protection. Wall Street couldn't see through it. The regulators couldn't parse it. By the time the truth emerged, the money was gone and the executives had moved on to other ventures. Penn Central became a template, not for how to run a company, but for how to destroy one while enriching yourself. The pattern, merge, financialize, hide losses, sell shares, collapse, would repeat. In the 1980s with leveraged buyouts. In the 2000s with mortgage securitization. In the 2010s with tech unicorns. The real lesson isn't about railroads. It's about what happens when complexity becomes a smokescreen, when the people running companies care more about stock price than operations, when auditors are paid by the companies they audit, when regulators move at the speed of bureaucracy while finance moves at the speed of greed. Penn Central didn't collapse because the railroad industry was dying. It collapsed because its leadership chose financial games over honest operations, and because the system that was supposed to catch that chose not to look too closely. Subscribe for more stories of how complexity hides fraud. There's another one every week.